Okay, welcome everyone to today's webinar. We've been working on this webinar for quite some time, so I'm really excited to be joined by Mo. And for those, before we get into the topic, I would love to welcome everyone to today's webinar. My name's Liz, co-founder of InvestHer, and we believe it is a woman's birthright to become financially free, and that's what we stand on here at our InvestHer community. So if you're joining us for the first time, thank you for being here. And I'd love to hear who is here and where you're from. Let's just get connected. The one thing I love about our community and our network is that women are active, they're connected, and they want to be connected. So please share in the chat box if you don't mind your name, where you're calling in from, and also how we can make this time the best spent for you. There's a lot of things we can do with our time. You're choosing to be here with us. And we don't take that lightly. I know Mo doesn't take that lightly. He's an entrepreneur as well. We have choice in our time. So I'd love for you to share your name, where you're calling in from. And if you have an intention, if you have a goal, if you're interested in something specific, please put that in the chat box because we'll take a look at that and, quite honestly, make sure people are getting their questions answered and the support that they need. So let's see who's here. I only see in my chat box. So your name and where you're calling in from, please, and then we'll get going here. But thank you for everyone being here. All right. So I don't know if people can actually share in the chat box because they're having a problem. Let's see here. That might be an issue. I'm not sure why. Oh, there we go. It is working. Okay, I was worried it wasn't working. Okay. Awesome, Ashley. Good to have you here. I don't think I know where Melbourne, North Carolina is, but it's probably somewhere cooler than where I am in the Northeast today. We're getting like 90. Oh, it's by Durham. Okay, awesome. We have properties in Winston-Salem. It's a great area down there. Love North Carolina. Love North Carolina's market, at least where we are in Winston-Salem. So thanks for being here. Awesome. So we're going to get going here. We like to be respectful of everyone's time, starting on time, ending on time. A couple housekeeping things. If you can put your questions in the Q&A box, that would be the best place to do it. I'm going to come on about 15 minutes in, interrupt Mo, and ask some questions. We want this to be engaging. We want this to be lively, and it's a ping pong versus all of you, doing other things. We want you to be as present as you can to this because it's a really fascinating strategy. And as we kick things off here, I got a chance to get connected to Amber Lee, who is Mo's colleague, at an event we both went to. And in talking with her, I was super intrigued with what they did and really invited them on to do this because I see such a connection and collaboration with our community. So if you have ever invested in the stock market, put yes in the chat box, right? If you know what the stock market is, I know you are all very smart women, but the idea is that there's, obviously index funds, and Mo, you're going to talk about this much more than I can. But what was really fascinating when I got a chance to get to know Mo and Amberly was there's actually a tremendous amount of tax savings that can be leveraged in the stock market. And often we don't think those two things together. So that was really the initial hypothesis, if you will, of what encouraged us to say, hey, let's have you come on, teach a bit about this for women who are real estate investors who are diversifying their portfolios and their income and their investments, and to know all the different choices out there. So without further ado, Mo, thank you for being here. Thank you for sharing your knowledge, and I will jump back in a bit so we can field questions and make sure women are getting what they need from this webinar.
Amazing. Thank you so much for having me. And I should say, as a girl dad, I'm very sort of like proud that this community does exist. I definitely think financial literacy is extremely important. And, I spend a lot of time actually with my two girls teaching them sort of like about, and they're still young, but I like to give them the basics early on. But to maybe get started, I want to first give you like the founding story of Frec and how did it come about. We're a startup, we're a venture-backed company. We are backed by Greylock. Greylock is a one of the best on top, I would say, VCs in Silicon Valley. They invested in companies like Meta, LinkedIn, other like big hitters here. And they found us early. I was just a solo entrepreneur back in late 2021, and they wrote us a big check to like go down this mission of trying to bring sort of like these sophisticated, complicated strategies that are typically reserved for people with millions and millions of dollars. And you have to know the right hedge fund manager, the right wealth manager, to bring those kinds of strategies to everyone else. And I was sort of like on a path to doing this because I kind of faced this problem myself as when I had my first exit and when I sold my first lot of private stock that I had as one of the first advisors at Instacart. I was swarmed by these wealth managers that were like, "Hey, did you know that this exists? Right? You can offset your tax bill by doing X, Y, Z." And I was like, "How come I've only known about this now? Like, I should have known about this before." And none of my friends know about this, and it's kind of this like big secret. And so I wanted to build a product around it, and so that's where Frec was born. Frec stands for fractional equity credit. It's a sort of like a nerdy thing, but it's it's the way we trade. It's all fractionally, and we give people sort of like a line of credits as well against their stock. But I'm excited to tell you about this strategy that basically marries stock market returns, right? S&P 500, if you're familiar, those types of returns, 8 to 10%, 11% per year, with also significant tax savings on your portfolio, whether it's a stock market sort of portfolio or outside portfolio as well, like a real estate, for instance, right? And so to kind of take you through this, I'm going to take you through the same process that we went through building this company. We sort of like started out with the first principles of it. Like, how did we get here? Well, how come everyone invests in ETFs and not in this direct index strategy? And why is it better? And then sort of like how it works. I'm going to try to quantify the tax advantages as well, so you guys can like kind of see it and how it applies to your own lives, right? And so you probably all are familiar with ETFs and mutual funds. Mutual funds starting in the 70s was a very tax inefficient way to invest your money in the market. Like every year, if the market went up, you'd have to pay taxes, even if you didn't sell, on those gains. And that's how mutual funds worked in a taxable account, right? And so ETFs came along in the 90s, and that was kind of the big revolution in a way. Oh my God, I can like buy this thing and not pay my taxes every year until I sell. Back then, it was like a big thing, right? And so that's why they took off. Now they're way larger than their mutual fund counterparts for, in terms of a growth rate at least. And then so think of direct indexing as the next evolution. We've sort of like now have taken, the tax advantage of ETFs and made it even better with tax loss harvesting. And we also can let you personalize your index. For example, if you want the S&P 500 minus XYZ, maybe you work at one of the companies or something like that, or you have a spouse that works there, you could personalize the index and remove or add certain stocks or sectors from the index itself, in addition to the tax savings. So the kind of the one-liner that we use to describe direct indexing is that it's a tax deferral strategy, right? Taxes are not eliminated; they're deferred, right? We can't do that. We can't eliminate taxes, but we can delay them to further down the line. And you know, a popular way to describe that is it's kind of like an interest-free loan from the IRS. Like if you owe $20,000 in taxes this year, and you had a choice to pay that same $20,000 in 10 years to the IRS, which one would you choose? Most people would choose to defer because they can go in and compound that 20K and invest it in such a way that they get a benefit from that $20,000 in the meantime in those 10 years. And so obviously this is kind of a basic idea of compounding, right? There's the time value of money. And then obviously, at death, which is not a topic people love to think about much, but it's going to happen to all of us, is, there's a step up in cost basis that happens, right? Whatever assets you have, they will essentially be reset. And then if you have that outstanding $20,000 loan to the IRS and, something happens and, the assets are bequeathed, right? That step up in cost basis eliminates that loan that you took, right? And so that's kind of the buy, borrow, die type of mentality that a lot of very wealthy people collect assets, maybe try to not sort of like pass them on and step up the cost basis. I think with with the tax bill that's out there, the proposal is that you can step up to $25 million at death, right? So it's quite a bit for a married couple. So how does, and I think it's 12 and a half for a single. So how does direct indexing work, right? So the basic idea is if instead of buying an ETF like SPY, like we all have probably Schwab Fidelity accounts or something like that, we walk in, we go and buy, VTI, SPY, right? Very easy, one-click purchase, right? So instead of doing that, you would buy, you'd use a service like Frec. Others exist as well. I'll tell you about them in a second. But you can use a service to buy, instead of the ETF, you buy the constituents of the ETF. You buy all the 500 stocks at the right proportions, like 8.3% in Nvidia, 6.3 in Apple. Of course, you don't want to do that manually. That's why you need the algorithm to do it for you. But you buy the individuals, and what that allows you to do is for the platform to monitor those individual assets, and anytime one of those assets loses value, it can be sold and rebought again to book that loss, right? And then what happens at that point is you're accumulating these capital losses that are then reported to the IRS at the end of the year when you file your taxes. You get a 1099-B. It says, well, okay, you just had this much in tax losses, and then you can offset your gains with these tax losses and save real money, right? And the key thing here is that you're not sacrificing market performance, right? You have a bit of tracking error. You can be plus or minus, sort of like your performance against the index, but you're not sort of like giving up real performance here. And we'll kind of dig into that point in a minute. So this is what a direct indexing account looks like. You have and this is a real account, by the way, with real funds. If you go to frec.com on top, there's a live demo link, so you can see it yourself. And this screenshot was taken back in February, and now there's almost 4,100 tax losses when I checked this morning. So it's constantly working for you on generating losses. And so the idea is like you see your constituents, Nvidia 7.25, Apple, Microsoft, Amazon, all 500 or whatever. You see how close you are to SPY because when we built this product, we figured people will want to continue to double check that they made the right choice by buying a direct index, and you can see that live that you're not going to be that far off from if you had bought SPY. In this case, you're off by $100, and but you've harvested $2,600 in capital losses. These $2,600 in capital losses are going to save you way more money than whatever tracking error you would have had, right? And then obviously, then the question becomes, well, like how much can I harvest? Let's say I want to invest $100,000 in the stock market. How much can I get in losses? Because you may be thinking, well, I have a property I want to sell and it's got this much in gains and I'm not going to do a 1031 exchange. Maybe I want to pocket the money, but I want to offset the gains, right? And so this is where sort of like you can estimate now that you can harvest about 40% of your investment in capital losses, right? Over 10 years. So invest $100,000, you're going to get back 400K in cap losses in 1099-B forms, right? Through this algorithm. Of course, it depends on what index you're in. So Frec, we offer about 16 different indices. We have growth large caps, you have Russell 1000, you have like anything you desire is probably there. And if it's not there, you can just ping us and we'll add it. But we've licensed most of these major licensed index providers. And each of them kind of harvest losses at a different rate just because they have different constituents that are behaving at a different sort of like volatility, right? The other kind of thing to note is that the losses from direct indexing are front loaded. So they happen in the first few years and then they kind of plateau and go down. Now, a couple of things I want to say about this. The first thing is, as you deposit more money, each new deposit kind of behaves this way, right? So let's say you start with some number and then a few years later, a few months later, you put in another sum of money. That sum of money, the new sum of money is also generating losses for you. So it's additive, right? And then maybe the second thing I would want to say is that there's a solution to this to make it not go down like that. And it's a new product we're building called the long short direct indexing index that I'll maybe touch on at the end if there's any questions about that. But for the most part, this is kind of a good thing. You want the losses to be front loaded. You don't want them to happen in later years because you kind of want to use them right away. And then, this is just, a slide on how popular is this strategy. And you may not hear about it so much in mainstream media because it's kind of an emergent strategy, but there's still $825 billion in it invested, and it's growing at a fast pace, 12.3% every year. ETFs are growing, but at a slower pace. Mutual funds are actually declining because they're not very tax efficient. They're kind of primarily used in retirement accounts now. And so it's a very exciting trend for the industry. And the reason this is kind of happening and this like doubling of the assets is happening is because the technology has evolved and we can do things like fractional shares, like we can buy fractions of a share and keep you kind of super, super closely tied to the index. There's no commission trading. We trade a lot, right? For a 100,000 account, we trade $500,000 worth of stock. It's a lot of trading, right? It's 5 times the volume. And then there's obviously a lot of compute costs to compute these, how do we like reorganize the index such that we sell and we buy again. Um, okay, so this is probably like a good um, uh, spot to talk about how do you apply this theory in practice to maybe your life, and how does it actually help you save money? And so I guess like the way we think about it is if you have money that's going to be invested anyways in the stock market, right? And if you're going to put it anyways in an ETF, like VTI, SPY, whatever the solution is, you could, if you put it instead into a direct index, that's what DI stands for, a direct index, you can start collecting these capital losses. I sometimes think of them as credit card points because you just are accumulating these things and they're never lost. They carry forward 1 year to another, right? And you can like one day if you have a gain, let's say you sell some real estate, right, in year 3, and you're like, geez, I've got a $200,000 gain on this thing. If you had $200,000 in losses, you pay zero taxes in cap gains, right? And so you offset, there's no limits. You offset whatever amount you have in cap gains with cap losses, right? And then if you run out of these cap gains, by the way, and you have no cap gains to offset, you can offset $3,000 of ordinary income on top of the gains that you've offsetted, right? And that's kind of nice. $3,000 ordinary income is quite a bit of money for a W-2 employee. Liz, I see you. Yeah.
Yeah, Mo, quick question. And I think this is a great question for everyone on. So I'm literally about to sell a property, right? And we're not going to do a 1031 exchange, which is an option for a lot of the women in our community. But for a variety of reasons, we're not doing a 1031. So we have to be really mindful of, how we approach the gains, right? From this property and how we can legally reduce our tax burden. So what you're saying here is I sell my property, I have a gain of XYZ. Say I have $200,000, right, of my gain. How does putting the $200,000 into this process reduce my tax liability? Can you explain that a little further?
Yeah, that's a great question. So you sold the property in, let's say, in June, right? So
Yep.
now how many months do you have left in the year? You have like basically from July until December, right? So
Okay.
if you take that money, the proceeds from the sale, and let's say it was anyways destined to the stock market. I don't know in your case if it was or not, but that's the first decision is like, what do I want to do with the money?
Well, yeah, and let's play this out because
Yeah,
my husband and I are considering it's more than 200,000, but
yeah,
for this
yeah,
example, let's go with 200,000. And we're considering different options, more path of opportunities, and we're very comfortable with real estate. So do we put it in a debt fund? Do we put it
yeah,
in a syndication, right? So, however, that's all real estate. So
right,
I think there's a lot of women in our community that are also very open to diversifying in the
right.
stock market, right? Because they're so heavily in real
Yeah,
estate. So knowing that some of my investments might be tax advantage and some of them may not be because a debt fund won't give me any tax advantages.
right.
How does that play out with what you're about to share?
So if you sort of like get comfortable and make the decision to like put the proceeds into the stock market, then a direct index will basically work for you. So as soon as you have the proceeds from the sale, if you start a direct index of let's say the S&P 500, for example,
Mhm.
which By the way, the S&P 500 has done 10.5% a year for the past, if you do the math, since it was incepted in 1926, they kind of that's kind of the average rate of return, 10.5% per year. But if you decide to put it there, you'll still get those returns, the 10.5%, plus or minus a tiny tracking error. But on top of that return, you will also receive capital losses. So by the end of the year, Frec or another direct indexing provider would send you a 1099-B that says, you now have from this, call it 200K investment, you've collected $30,000 in capital losses, right? You didn't have to do anything. It's just by virtue of you investing in the market and putting it into the S&P 500, you have until the end of the tax year. So it's nice to do this at the beginning of the tax year, like maybe in January, because then you have the
I
whole
see.
12 months to do it, but you still are not too late in June or July. And then this is sort of like where our new suite of products that we're launching actually in July, in 4 weeks, is very exciting. So long short direct indexing, what it does is it amplifies the losses harvested. You have to choose a factor tilt. So this gets a bit more advanced. You have to be like, well, I want the S&P 500, but I want it to be tilted towards growth, for example. That gives you an opinion about the market, um, and then you can now harvest 3 times as much. So instead of harvesting $30,000 in losses, now you harvest 90,000 in losses, right? So when you go and file your taxes, you're like,
Right.
okay, 200K in gains, I have 90K in losses. I'm only paying cap gains on $110,000.
That makes sense. So my question is, me taking some of that money and just investing in mutual funds, I'm not going to get any tax losses. So why in this approach, and maybe you said this, but why with this particular strategy am I open to that opportunity when we don't think of the stock market and tax advantages?
Yeah, so most people now invest in these ETFs, right? And ETFs are like they are sort of like a legal sort of like financial, it's a wrapper around the stock. So when you buy VTI or SPY as sort of like a wrapper of stocks, right? Underneath it, the managers are going out and buying the 500 stocks for you, right? And
I
so
see.
that's already happening, but because of the convenience of it, and some of the intricate sort of like laws around, there's a Nixon era law that allows them to not pass down the cap gains to you every year, but by virtue of not passing down the cap gains to you, they're also not passing down the cap losses to you, right? So if you get rid of that wrapper, you can then, and use like an intelligent algorithm, like the one we have today at Frac. You can then take advantage of the losses, but not the gains, right? And
Mhm.
that's what all the wealthy people have figured out. Like, oh, I've before building this company, I talked to all these family offices. I did a tour, like massive family offices, $1 billion plus in assets, and they allocate to private markets, they allocate to public markets, and their public market allocation is not an ETF or a mutual fund. It's
I
always
see.
a direct index because it generates losses that they use to offset the gains from their private investments, right? And like, why can't we apply that at the individual level? We all have some alts or some private, like angel investments, or in your case, like real estate investments that generate gains. And so you want to accrue and accumulate these losses to be able to offset them.
Makes sense. So the direct, so let me ask you another question. Keep going. This is
Yeah.
helpful. I just want to make sure everyone's getting this. Is when you think of the stock market, is direct index it in line with a mutual fund, or is it a type of mutual fund, or two separate things? It's a strategy, and then the mutual fund is the actual stock. Help us understand all
Yeah,
that for those who are
totally.
not familiar.
Very good question. So they both buy the same thing. So there's these like indices that exist. The
Okay,
S&P 500 is an index. It's literally a data company. Like this company goes and says, well, I've done my research and I've determined these are the best 500 companies in the US.
I see.
That's what the S&P does, right? And then they have this data, right? And then they license that data, and various providers like use that data to issue a product that you and I can buy.
Okay,
One such product is a mutual fund. Another one is an ETF. A third one is a direct index, and they're all kind of built differently. So
okay,
mutual funds, for a mutual fund, you literally have to like create a fund and then have a manager of that fund, and then the manager goes and buys the 500 stocks and rebalances them, and does the trades, to rebalance them, right? The ETF is a bit more automated and passive, right? But it's still like a fund. And a direct index is running on a brokerage account. So it's like it's just very modern software driven. You don't need the fund, you don't need the human that's doing the trades. The software is doing it for you. We still license the same data that they license. We still buy the S&P 500 licenses and know the target weights and like rebalance you every day and do all that stuff. But it's done with software and automation, and it's not done with humans. And there's no like, kind of yeah, there's no like wrapper around it, right?
I see. I see what you're saying. So it's a comparable EFT, mutual funds, and direct index is all like comparable
Yeah.
products, if you
You're
will.
still getting the same performance at the end of the day. You're getting,
Okay.
the market moves 10%, you get 10% in all of them, but with a direct index, you also get the tax savings on top, right? You get those credit card points. Like just like, you can go and buy stuff from a store with cash or credit card, same thing, right? But with a credit card, you'll get the points.
Got it. I want to open it up to all the to the participants. Any questions, please post those in the Q&A box, in the chat box. Just want to make sure. Okay, Kimmy. Kimmy's one of our Strive members. Hey, Kimmy. I love this because I think my financial advisor should be monitoring this for us because I don't think they're actively doing this from a tax planning strategy. Can you explain how the capital losses are captured? Are you saying we initiate a sale of specific stocks in our fund to capture the losses at any particular time? Can you also explain how let's answer that and then we'll go to the second part of the question.
Yeah. So you literally don't have to do anything. Like you basically come in and to the platform, whether it's Frec or something else, by the way, like other solutions exist as well. We're not the only player in the space. Like you can go to Fidelity, Wealthfront, etc. You go to those platforms and you're like, I want to deposit $100,000 into the S&P 500 or into the total stock market index or whatever your favorite index is, right? As soon as the money arrives, that's it. It's all taken care of for you. It will automatically rebalance. Like maybe it's a good time to actually show you a live demo of the product, just kind of put it in perspective.
Yeah, that'd be great.
Yeah, let me kind of share a different screen here. But the TLDR is no active management on your side. The losses are automatically harvested because in the background there is an algorithm that's running every single day that determines whether to trade or not. And if it sees like that Tesla's at a loss today and Tesla's in your portfolio, it will sell it, book the loss, right? And then go in and buy something else for 30 days because there's a wash sale window, right? And then come back and buy Tesla later. So let's look at this live demo account on Frec. This is what an account would look like. Actually, you know what? Let me do something even more exciting. I'll log into our actual demo account that is funded with more funds to kind of show you all what the experience is like to deposit and so on. So here's an account. This looks overwhelming, but there's like 5 different indices, right? So let's say this was empty, right? You didn't have anything. You'd come and say, well, I want to invest, and you pick the index, right? So this is the S&P 500. Here's the semiconductor index. Here's the S&P 500 info tech, if you're like a tech enthusiast. And so you pick your favorite index. I'm going to pick the Russell 3000, which is basically all the stocks in the stock market, in the US stock market. I'm going to say, well, I want to invest in this thing. Okay, great. So this one has a higher minimum investment, $50,000. Most indices on Frec have 20,000. And by the way, the reason why there's a minimum is because we need to go and buy these positions to do the tax loss harvesting we just discussed, right? Like when monitor Tesla, etc. So you go in, you don't have to, 50% of our customers don't customize. They just go in and buy the index without tweaking it, but you can go and tweak it if you want. You can remove certain stocks that you don't like, add other stocks, and then you deposit stock or cash, right? Or there's a line of credit option, but most people do cash, right? And so they bring in cash, they connect a bank account, and they bring in $50,000 or whatever, and press continue, and that's it. That's all you got to do. I'm not going to do it here, but then you have an index that runs every day, and you see like year to date losses harvested on this account, $93,000 in losses harvested, right? Now this account is large and it had a lot of stocks that have been highly appreciated, so it didn't harvest as much, but you can expect on a $3 million account in the first year of its operation to harvest about $450,000 in losses, right? If you had put the same money in an ETF, you'd harvest like $0, right? And so you can monitor and see my index. Here's what it did. tax losses harvested yesterday. Yesterday, it harvested $146 in losses. Let's see what it did. It sold these stocks and bought these other stocks. So it
Hmm.
sold these at a loss, bought these other ones. It's like doing that every day. And it's avoiding the wash sale window as well. So there's an IRS rule that you can't sell something, book a loss, and like rebuy it right away. You have to wait 30 days. So it's doing all of that for you automatically. Does that make sense?
Yeah. And let me ask you this. How much are individuals involved in this, and how much are their financial planners involved if they're handling a lot of the stock kind of moves, if you will, stock investing moves? Where does individuals kind of their role begin and end? Or
Yeah. So we designed this for the individual to be able to do it themselves
okay.
with ease. Usually, if a financial advisor is like involved, they typically like get access granted by the customer and they kind of do it for them. But really, like, there's not much work involved here, right? Like, you just put in the money and you let it do its thing. And
Okay.
we all sort of like most of our customers are very long-term investors. They're not trading and rebalancing, and they're just putting money in the
Mhm.
S&P and letting it be. And so if that's the case, a lot of them prefer to like save money because financial advisors can be expensive. They can cost like 1% or something like that in some cases. So some of them prefer to like, just do it themselves, save the 1% a year and let the platform do its job.
Okay. Okay, great. The second part of Kimmy, your question was, can you also explain how the losses are recorded, passive or active, on our tax returns?
So, the capital losses are typically categorized as long-term or short-term losses, right? I'm not familiar with passive or active, um, but so we break down the short-term versus long-term harvested losses. And so typically what happens is short-term tax losses are more valuable because they offset short-term cap gains first, right? And so if you have like short-term cap gains are expensive. If you bought a stock and sold it within 6 months, you're paying ordinary tax rates on them, right? And so these short-term tax losses completely offset those. And then long-term offset long-term. And if you run out of one, you can offset the other. So if you uh, you know if you only have 5,000 in short-term cap gains, you'll consume 5,000 of these, and you have 85,000 left that you can then consume against long-term cap gains.
So Kimmy, my suggestion would be just to run that by your financial planner of just to make that connection, and what is short term and long term in relation to what you're asking. So might be something to, and also quite honestly, your accountant, I would run that by your accountant too, possibly. They kind of know your whole financial right framework. So
Yeah,
uh,
I would ask a question to my planners of like, okay, well, how much of my portfolio is in equities, US equities, public market US equities, right? And then and out of that portion, you know, um, are there opportunities to transition some of those positions into a direct index so that I can start to capture passive capital losses, right? I'm not doing anything, it's just being captured for me and every year saving me money on my taxes.
yeah, and how much that they may need. Okay,
Yeah.
great. That's helpful.
Awesome. I'm happy to continue sort of like going through the slides, but if there's any questions, please feel free to stop.
Well, yeah,
Yeah.
and I would say one of the biggest things, right? Because we do this a lot in our webinars, is like, what's the next what's the next three steps if someone's interested in this?
Hmm.
They clearly have experience in real estate. They clearly may have a potentially a financial planner. They have other investments in other asset classes, and they want to make the right call, right? We want to we want to make the most and decrease our taxes most legally, and create the life we want on our own terms. That's what we're all after. So what would be 1, 2 steps that someone would take to kind of explore, is this a good fit based on their own financial goals and their own financial assets, right? Because that obviously depends.
Yeah, that's a great question. So I would start with looking at my past tax returns. Maybe I'll talk to my CPA or something like that and be like, hey, like for the past 3 years, how much have I paid in capital gains, right? And you know, chances are, you've paid something, but if you've paid nothing, then, maybe this product isn't going to be super helpful, right?
Sure.
But if you did pay something, then you can say, well, okay, I could have these numbers could have been zero, right? And then you would also want to map out your future, like maybe think about like 3, 4 years down the line. What are some of my investments that are about to like mature? What are some of
Mhm.
my exits that I'm trying to make? And how much am I expected to incur in cap gains, right? Because you want to multiply that number by, like, let's say you have
Yeah.
you did incur that $200,000 in gains or whatever. Depending on where you live, depending on your state, it can be quite a heavy tax bill. Like in
Yeah.
where I live in California, like selling stock that IPO'd or something like that, you're paying almost you're paying about 13.3% to the state, and then you're paying another, probably 28% or something like that or like, sorry, 37% on federal. So if you add them together, 50%, right? And so you can
Right.
offset all that, right? And so
Yeah.
do some like backwards looking, just research on how much you've paid in cap gains, do some thinking about the future, and then sort of like from there you can say, well, I think it makes sense or not to accrue and accumulate capital losses as another item on my personal balance sheet. Like I have this much cash, stocks, and I have this much in cap losses to offset these future gains, right?
Right. Yeah, no, and that's a big decision maker. Like I said, I'm personally going through this, right? We're selling an asset. We're not doing a 1031. So my immediate concern, right, is to okay, how are we going to maximize and so we don't have an enormous tax liability? And what do we do to do that? And also not what do we do, but what asset classes can we,
Hmm.
and obviously women they love real estate, they're investing in real estate, but a lot of women have expressed their interest in diversifying outside of real estate as well. So they have a little bit of a balanced portfolio. And I'm not a financial planner. However, a lot of women are very interested in that so they can kind of hedge their risk, right? So I think a conversation with your accountant slash financial, I would start with your accountant would make the most sense in my head because they're not going to push you one way or the other. They're going to give you facts, especially if you're about to sell properties or gain, um, gain quite a capital gains. Also, you have a lot of people doing wholesaling, flipping property. That's all capital gains, right? That's a big capital gain. So it's not just selling a property from like a rental portfolio. It's flipping. There's a lot of different strategies that would cause us to have money that we need to figure out in terms of how do we decrease our tax liabilities. Okay, cool. Any other questions, please put those in the chat box in the Q&A. But if you want to share your final thoughts there, Mo, we can give everyone just some space to take some action. That'll be great.
Yeah, I guess like I want to like maybe fast forward to, I think we basically covered a lot of this content already, but fees, etc. But I want to like talk about one product which I think might be very interesting for this community of real estate investors, which is our line of credit product. So on Frec, you can actually borrow against your stock too. And
Hmm.
then if you take a loan against your stock and use it for an investment purpose, there are other tax advantages there as well. So what we find is that some of our customers, they when they invest in a direct index, first of all, they're getting the capital losses from the tax loss harvesting of the direct index, and then they tap into this line of credit against it at a low rate of Fed plus one, which is 5.33% today. If the Fed cuts, this will come down as well, and so you're borrowing against that, right? By the way, the line of credit against a direct index does not have a payment schedule like a traditional loan. You just pay it back whenever you want to pay it back, right? With the caveat, of course, if you borrow too much, you may be subject to margin calls. But if most of our customers borrow 10%, 15%, right? And so that's not a big amount at all. Even a 50% correction in the stock market is not gonna sort of like cause a margin call with a 10, 15% loan against it. And your interest accrues into this line of credit, and then you can take that money outside of that platform and go and fund that renovation project or like the home flipping project that you have. So it's a new source of funding as you think of real estate investments. And so
Yeah.
the core portfolio can be in a direct index that's going to recap losses. If you ever need access to that liquidity, you can always sort of like borrow against it and pay this interest rate, but be able to basically use it for other purposes.
Question, Mo, on that, and then I have another question here. Um, can you, for funding that line of credit, is that just cash? Is that, where are people funding that? Or is it redeploying money they already have in the stock market to a line of credit? I'm just not following where the source of that money is going to come from.
Yeah, so the line of credit itself is basically funded through our clearinghouse. And so when you sort of like, I'll go back to the product demo for a second, just to put it in perspective for everyone. So this is an account that has $3.3 million, right? And so if I come in here and say, well, I want to take a loan against it, this is a loan that's secured by these assets, right?
I
Just like
see.
think of it
Okay.
as like a HELOC, right?
Yeah, I got
Home
you.
equity
Yep.
line of credit, right?
Yep.
I'm
Totally.
gonna go and borrow this amount of money right here. I'm gonna take whatever, $1,000. There's a $2.3 million line of credit, but I'm only gonna borrow $1,000, and I'm gonna put it in my bank account because I'm gonna go in and I don't know, do something fun with it this weekend or something. I don't know. But you can do that. Or you can take it out and invest it further into the portfolio, right? But
Mhm.
if the proceeds of this loan are used for an investment purpose, for
Mhm.
example, uh, you're using it to purchase a rental property, then our understanding is that the interest on this line of credit, the 5.33%, is tax deductible against the income of that rental property, right? So there's additional tax advantages. So if you use this product wisely, you can actually sort of like get liquidity against your portfolio, your stock portfolio at any time. You don't have to like sell it, right? And then
Yep.
B, yeah, also get a tax advantage by offsetting the interest on it.
Got it. Okay. Got another question. Charlene, thank you. Thank you. I learned something new. Yes, I think this is super fascinating. It's another, as we say, tool in your toolkit as you're building your wealth. You need to know different options out there. Lavette is asking, would the strategy work if you are withdrawing funds from retirement accounts that will be a taxable event? For example, taking the IRA withdrawal and reinvesting in like a direct index to offset the tax.
That's a very good question. It's actually an excellent question. I don't know that I've thought about that before. Um, I believe the IRA withdrawal is taxed is it if it's taxed as a capital gain? I need to check on that actually and maybe get back to you, Liz, on it. If it's taxed as a capital gains, then the cap losses can absolutely offset that gain. But if it's taxed as ordinary income, then it doesn't. So I need to just maybe I'll ask maybe Amberly, you can help me kind of look into that as well.
Yeah, that could be also, Lavette, a quick question for, I would imagine your accountant would know that too.
Yeah, I think the accountant
Yeah,
absolutely. I mean, that's what we would do, go and ask an accountant friend of
yeah,
ours. But yeah, I think that would be a
yeah.
great question.
So
Yeah.
then they kind of know, but the, yeah, that's always helpful. Because I always say, the bottom line is when you're making decisions, right, on a new investment, whether it's a real estate property or it's the stock market or it's direct index, your accountant has a holistic picture of your financial like profile, even beyond your financial planner. This is all again my opinion. So that's why an accountant, a strategic accountant, when you're buying, you're selling, you're making investment decisions, is really helpful before you do that, so you can plan accordingly. I'm meeting with my accountant before we sell this property, right? Obviously, because I want to really come up with a plan to maximize the money we're making, as well as really being mindful of the tax implications. So Levette's asking if you can, as we wrap up, Mo, share a little bit about how the fees work for using Frec.
Yeah, I'm glad you asked because that's kind of one of our selling points. So back to the origin of the company and the story behind it. When I sold that Instacart stock, and everyone was coming out and telling me to use direct indexing to offset the losses, my first question is like, how much would this cost? And their answer was like, oh, it's going to cost like 0.5%. And in my head, because because I do math all the time and I enjoy these things, is like, okay, wait, 0.5% for this, but the ETF costs 0.03, so I'm paying an extra 0.47. Is it worth it? Right? I'm just trying to do the
Yeah.
math. And so the right way to think about this is, so to answer your question quickly, the fee is like 0.09, so 9 bips on the S&P 500. On some of the other indices is zero point 0.1. There's indices that are expensive like 0.27, but they're sort of like relative to the closest ETF, right? And so I want to sort of like justify and explain to you why the fee makes sense and why it doesn't make sense for more expensive products, right? And so look at this chart. This chart is basically the difference between the price of the ETF, like the math I did, 3 bips for VTI versus 50 for the direct index would be like 47. It would put me like between green and purple here, right? And so if I'm paying this much in fees every year to have a direct index harvest losses for me, and my tax savings are coming in the first 5 years, right? Let's say like $1 million, right? So I saved money in the first 5 years. I put that money back in the market, right? So now I'm compounding, I'm kind of exceeding the ETF, right? But if this fee is too high, I'm not harvesting any more losses here. The fee is going to sort of chip away at my portfolio such that like I am touching the x-axis again, meaning there's no difference between the direct index and the ETF, which is why I think this product should be, it's very fee sensitive. Like if someone came to you and said, buy a direct index for 1%, just run away. It just makes no sense. It's like saying, well, I'm going to give you this credit card. Every time you swipe it, you're going to pay 2% extra fees. Plus, you're going to get these credit card points. Like, who cares about the credit card points?
Sure.
I'm paying 2% fees every time I swipe, right? And so that's kind of the problem with this product is it's been abused. It's been marketed at too high of prices. Luckily, now the whole industry is converging back to these like blue and orange ranges. We're proud to be at the blue, right? Most of our indices are in the 9 bips. Our more expensive indices are like 27 bips of Russell 3000 that I showed you is because the ETF is like 19, right? So we're just like
Sure.
8 more than the ETF. But so the idea is like you need to sort of like have this product make economic sense to you such that the tax savings outweigh the fee of maintaining this
Yeah.
portfolio for a long time, right?
Yeah, that's the goal, right? Very cool. Yeah, no, this is great. I'd love to hear from folks because this is a whole new concept that some women may not have considered as part of their wealth building plan. So I'd love to hear in the chat box any other questions or just your one takeaway. One action this is causing you to take as a result, because that's what that really becomes the most important thing when we do any training, any webinar, anything really within our community is what one thing are you going to take away with you and do something with. So action can be taken and then, as we say, the needle can be moved versus like, wow, this is really interesting, I'm not going to do anything. Well, what's one action could you take as a result of today? I'd love to hear that in the chat box, and any other questions and any other thoughts for you, Mo, as we wrap up here. I really appreciate the overview of this super fascinating option to really reduce taxes.
No, we've been building this product for the past year and a half now, and yeah, we've been fascinated by the adoption of it. And you'd think, oh, it's only going to be folks with like a lot of cap gains that are using it, but we have a variety of people, like we have a lot of investors, doctors, teachers. We have just various professionals that are using it, such that they can be better prepared for a future where they have that big tax bill. And we've gone from zero to maybe a bit of on our growth. It took us about 12 months to get our first 100 million in assets on Frec. And then, we just closed the last 100 million in 3 months. So,
Wow.
so it's been accelerating. And yeah, it's a very exciting time for us. And
Yeah,
yeah.
that's awesome. I don't see any other questions or anything or any other thoughts, but again, thank you so much for coming on and sharing this concept. I love the next steps there, Amberly. Thank you for sharing that in terms of just people wanting to learn a little more with connecting with your team and obviously getting started. Kimmy, I'll definitely explore this type of investment. I love that it captures the tax losses automatically. So 100% be inquiring. Yeah, it's listen, the less we have to do and think about, right? That's always helpful. That's helpful. And Amberly, you've been great. So Amberly, the contact, like I said, I met her many months ago, and I was so intrigued. I said, what a interesting, different, but really fascinating concept for the women in our community in particular, because we know we want to keep more of the money we're making and build our wealth. And this seems like a piece of the puzzle, right, to the global wealth building strategies. So thank you everyone for being on. Do something with what you learned. And Mo, Amberly, thank you so much for being on and sharing this with our community.
Thank you so much for having me. I really appreciated it.
And the recording will be available for everyone as well, because I'm sure you might want to listen and learn a little further. That'll be on our blog page as a follow-up. And look forward to seeing everyone on a future training here. But thank you so much for everyone's time.
Okay, thanks. Bye.
Take care now. Bye-bye.